वो सुबह कभी तो आएगी.
It is this movement of people, this tremendous movement of people and ideas that is going to define this country. It is this energy that is producing your best managers. It's driving the stock market.
स्टॉक मार्केट में भी एक जो रिटेल का क्षेत्र है, दूसरा इंस्टीट्यूशनल इन्वेस्टमेंट है और तीसरा एफआईआई का है. ये तीनों का इक्वल बैलेंस होना चाहिए.
There has been a continuous, lack of awareness in terms of stock markets. Now, half of the population of India might not even be knowing where their money is actually going in the stock markets and what actually are the returns that they and the country are going to get through stock markets.
Foreign institutional investors Indian stock market में volatility ले आते हैं. मार्केट ऊपर जाता है तो वो FIIs की वजह से, और जब वो पैसा निकाल लेते हैं तो स्टॉक मार्केट झटके से नीचे आ जाता है. इसलिए FIIs पर कैप लगाना देना चाहिए ताकि हमारे स्टॉक मार्केट्स में एक स्टेबिलिटी बनी रहे.
Unless we have financial inclusion, which means access to banking system and providing appropriate products to people who really need them, to a wider group of people, unless we have it, we cannot really talk about sustainability of the system in any meaningful way.
सेविंग्स आजकल लोग गोल्ड में करना चाह रहे हैं क्योंकि महंगाई बढ़ रही है. तो हम ये चाहते हैं कि हमारी सेविंग्स फाइनेंशियल एसेट्स में जाए, ताकि बैंक्स में जाए, सो दैट कॉर्पोरेट्स कैन टेक लोन्स एंड दे कैन इन्वेस्ट.
Stock market investors have to be guided, have to be given incentives for holding on to stocks in the long run, rather than be only day traders.
Money market short-term instruments, if they are made available for the public, then you would be able to help increase the vibrancy of the money market.
देश की डेवलपमेंट स्ट्रेटेजी में हम फाइनेंशियल सेक्टर को इंक्लूड करना होगा और हमने भी इंक्लूसिव फाइनेंशियल सेक्टर के कंसेप्ट को विकसित करना होगा.
Hello and welcome to Change India, an agenda for the next Prime Minister. Today, in the 12th show of our series, we have 10 policy initiatives that will enable the next Prime Minister to liberalize India's still insular financial sector. The average Indian citizen is excluded from the benefits of simple financial services, whether it is a bank account, insurance and pension. This has to change. Our suggestions have been culled from recommendations made by a group of experts, and you can get all the details from our website thinkindia.in.com. Joining us in the studio are three experts who know the sector inside out. We have Dr. Ajay Shah, professor at the NIPFP and one of the country's most distinguished experts on finance. Mr. Rashesh Shah, chairman and CEO of the EdelweissGroup and a top practitioner in the world of finance. And joining us on a satellite link from Mumbai is Mr. Percey S. Mistry, chairman of Oxford International, an advisory firm, who has also chaired a high-powered government committee on making Mumbai an international financial centre. And with them is our very own Dheeraj Nair, CEO of Network 18's Think India Foundation, who has anchored this project for us. We also have an audience in the studio, among whom are some people who have actively pitched in to the debate on Twitter and on our website. Do note that we will present our suggestions on financial markets and 13 other policy areas to the next Prime Minister who takes office in June. So we are ready to go with our first three recommendations for the next Prime Minister. The first one is a rather critical one. We are saying the Reserve Bank of India, which is currently not an independent body, we are saying make it independent from the Finance Ministry. Interest rates should be set by a monetary policy committee, not by the governor of the Reserve Bank. Remember, today the governor can overrule the committee. And this committee should be appointed by a bipartisan forum, which includes the Prime Minister and the leader of the opposition. So that's point number one. Point number two is something that you've all seen a little while ago when we had the scandal in the NSEL. We are saying the forward Forwards Markets Commission, which currently is under the purview of the Ministry of Consumer Affairs, should really be taken out of the government's control and go under SEBI. And the third point is, that's a macroeconomic point. Unless you do that, you will not be able to remove several of the ills that plague India. We are saying your fiscal deficit has to come down to 3% of the GDP over 36 months. So those are the first three recommendations that we have. Let me go across straight to Percey Mistry in Mumbai.
No question in my mind that that needs to be done sooner rather than later. India must be one of the few large economies in the world that does not have an independent central bank. And I think it's absolutely necessary that we do. Of course, the question of how the governor is appointed and how the Reserve Bank is regulated and governed itself.
Yes.
In the United States, in the UK, etc., that's done through parliamentary committees,
yes,
where the governor testifies on a regular basis as to what monetary policy is all about. And I think that practice should be adopted here as well. I think on the second point that you raised, Raghav, the FMC going to SEBI,
yes,
I would go a step further than that and say that we should, for the time being, have only two regulators, RBI for the banking system, not for NBFCs, by the way, just for the banking system,
right,
and all other regulators, whether it's the Forwards Market Commission, insurance, pension funds, should all be folded under a single financial markets regulator,
right,
of which the largest component at the moment is SEBI.
Right.
And third, you're absolutely right that unless we have financial macro balance,
yes,
it's very difficult to have a stable financial system.
Right.
I think the root cause of most of the instability in the Indian financial system today is the instability in government finances and the ability of the government, which owns so many parts of the financial system, simply to shift its problems from one part of the financial system to another.
Yeah.
I.e., when it cannot divest a particular company, it asks an insurance company that it owns to do that, or it asks an insurance company to recapitalize a bank when it can't afford to do it itself. This kind of incestuous, what I call incestuous nonsense, really has to stop in a relatively sophisticated economy like India's.
Right. So you're in sync with all our 3 points. Ajay.
So I'm also in sync with all the 3 points, but just for some thought and some nuance.
Sure.
The way we should think about RBI is that there is a principal-agent relationship.
Mm-hmm.
Okay, Parliament is the principal, RBI is the agent.
Right.
Parliament gives RBI the power to print money, and in return, Parliament would define some accountability. So
right,
when you say RBI independence, side by side, you have to say, so what's your accountability?
Right.
You can't just have
yes,
a bunch of unelected bureaucrats and economists,
yes,
doing whatever they please.
Yeah.
What they do has to be shaped by the political authority.
And would you include inflation targeting as a principle?
That is the
yes,
point. So
okay,
the inflation target
yes,
is where you bind the accountability.
Right.
So you should see independence and accountability as a package, that we have an independent central bank,
yes,
which is obliged to perform as measured in a numerical manner by the inflation target.
And which inflation, Ajay? Now, there's been some debate around this. Should it be the consumer price inflation or the wholesale price inflation?
I think it should be consumer price inflation, because that is what the man on the street sees.
Sure.
On the merger of Forward Markets Commission, I agree completely with Percey,
yeah,
that we need to actually go much further. We need to pull together everything into one agency, which FSLRC has called the Unified Financial Authority.
And this is popularly called the super financial regulator in media.
Okay. So this includes the currency and bond market work from
right,
RBI,
right,
the NBFC work from RBI, all the existing agencies, including the Forward Markets Commission. That would be a really nice way to put this together. For example, I would ask Rashesh Shah, wouldn't it be simple and clean for you if, whether it is currency or corporate bond or government bond or commodity futures or equities or corporate bond, all of it comes together with one regulatory system, one set of exchange screens.
Right.
It will reduce cost for everybody. The regulation will be done better.
And there's point 3, which is almost an axiomatic thing, right? You've got to get your fiscal deficit down.
The old NDA invented this FRBM,
yes,
which was then enacted by the UPA,
yes,
and then it was discarded.
Yes.
So we've got to ask the question, that was clearly not good enough. What can we do that is higher than that?
Yes.
We need to ratchet up the penalties and the constraints on a government
Yes.
that
which
chooses
breaches
to-
these limits. So you're saying mandate in law and then get penalties.
and ratchet up the penalties. With the FRBM, there were no penalties for violation.
And it could be rolled over, like the government did. They rolled it over once, they rolled it over twice, and then said we really don't need to follow it. Rashesh, you're in the practicing world of finance.
Yeah, I think absolutely. I think in principle, all 3 points, they make a huge amount of sense. On the first one, I think alongside what we have already spoken, it's also very important that the parliament sets clear objectives for RBI, because I think RBI is one of the few central banks that still has a plethora of objectives. They are trying to also manage currency rate. They are in charge of the bank stability. They are in charge of
regulate
inflation,
the banks as well, and the government debt. They also look after government
and
debt.
they also handle the government debt. So there are so many priorities. And I think increasingly, as we see all around the world, the fewer the priorities, the easier it is to achieve those.
So would you agree with Ajay when he says the overriding priority is inflation control and inflation targeting?
It's the only one. In fact,
it's the only one.
In fact, I think rupee and all, you should just take it out of the agenda. But I think we can come to that afterwards. Also, I think alongside what we have spoken, we also need to bring economics back in parliament. If you want to really allow, have the RBI governor going and explaining it in the parliament, how the monetary policy, the decisions are made, how FRBM coming back with 3%, as a cap. We need to. What I have seen in the last 10, 12 years, economics have gone away from parliament. I don't think economics is even argued and discussed in the parliament.
Yeah.
So if whoever is the prime minister should obviously, I think all three items that you have stated, they make sense. Except on the second one, where I would still say that given the expertise required, and if you see the US example, there are multiple regulators, but if you can coordinate it well, it can still work. It's not absolutely required.
But still take it out of the Ministry of Consumer Affairs. The government has got no business trying
Actually,
to
it's already happened. It just recently happened.
Yes.
It's come to finance. It's come to finance ministry now. Right. It's not with SEBI.
But that's still a ministry. That's still government exercising direct control on an exchange, which has been abused, as we've seen. An exchange which has been abused. Dheeraj, it's easy to put these things down. No. Will any finance minister, prime minister let go of this control that they have on the RBI?
Part of the problem with this is that it's not something which is of popular concern. I mean, it's not something which brings people out onto the streets like we've seen on several other issues that we've covered in these shows.
Yes.
Actually, the RBI is playing a big role in your day-to-day life. You don't know it.
Yes.
So that's why that institution needs to function properly. So there's the need for greater transparency, of course, within the functioning of the RBI. And the government can't mess around with that, because we've seen repeatedly instructions, veiled or otherwise, going to the RBI. Sometimes the RBI can resist, sometimes it can't resist. So we should get out of this system. And as the panelists have said before, the RBI cannot manage everything. It should just focus on one thing, which is inflation.
And you
in India, that would have a popular mandate, because inflation is something which does bother everyone from the poor to the middle class to the upper middle class. So it would have a popular mandate. And so let Parliament set that mandate rather than the government. And I think it's perfectly possible
leave
to
the
make
RBI governor free.
Let's get some popular pressure going on this change.
Okay, so let's get some popular pressure or a popular poll done in the audience. How many of you believe that the next Prime Minister will be able to have the sagacity and the political will to let go of the control on the RBI? Will he or she be able to do it? Yes? Raise your hand. No. You see, not even one person. not even one person believes. That's how much centralized power in this country has become. That not even one amongst this very well-known young audience believes that the next Prime Minister will let go of the control.
Come back on the political salience of this. Can we play a counterfactual? Suppose, so the UPA government over 10 years has experienced serious problems of macro policy.
Right.
Suppose today we had been holding 8% GDP growth and 4% inflation. Okay. Would the UPA government have been under the sort of pressure that they are today?
Oh, no, absolutely.
And so that is the point, that a politician should see that good macro policy makes political sense.
Absolutely, but politician after politician will not see it unless the back is to the wall, and the back is to the wall right now. We need to take a break. You go to our website, thinkindia.in.com, post your suggestions and come right back. Welcome back to Change India, an agenda for the next Prime Minister. Today we are looking at how the next government, led by the next Prime Minister, will be able to reform India's financial sector. We had a curious thing in the previous segment when we talked about independence to the Reserve Bank of India, and not even one person in our audience believed that the next Prime Minister would have the political will to do it. So, Mr. Prime Minister or Madam Prime Minister, you've got to believe, you've got to make all of us think we've got it wrong. We are now on points 3, 4 and 5, and these are to do with reforms in banking, insurance and pension markets. We actually have a very simple one-line reform, which is privatize all of them and let foreign investment come in. India must be one of the most underbanked countries in the world. We are saying you need to open it up completely, liberalize it, get 100% FDI, and the big public sector banks that you have, which are in desperate need of capital, which need to be recapitalized, and you don't have the money, break them up, privatize them, sell them off. Similar reforms in insurance. We must be one of the most underinsured countries in the world. You've got to get private capital in and break up LIC. Break it up, privatize it. Similarly with GIC and other insurance players owned by the government. Pension, which is a relatively new market that has allowed private capital in. We are again saying allow 51% investment by foreign pension fund managers and privatize and break up the NPF. So as you've seen, there's pretty consistent stuff in all 3 points. Let me begin with Percey Mistry. I know Percey's point of view. He's written on this extensively, and he even goes further than us, I guess. He says 100%, right, Percey, all across?
Yes. I think in a country like India, this distinction between domestic and foreign is now not only antediluvian and anachronistic, it actually hurts us because we're a terribly capital short country. We don't use capital terribly well. And I think that the experience with nationalization, both in banking and in insurance, has been a disaster for 2 reasons. The Indian customer has not been properly served, and government has used these institutions as its own personal cash cow.
I suspect you're referring to the SLR, the statutory liquidity ratio, and the CRR, through which the government actually appropriates almost 25, 30, 35% of the bank savings of the country.
Well, it's not just that. The way in which it determines priority sectors,
right,
when I don't think the government really has any idea what a priority sector should be. And it has reduced banking and insurance to box ticking. We don't really have in the public sector banking system anyone you could really call a professional, proficient banker. They're box tickers and they're told what to do all the time. We've essentially bureaucratized all these functions, and they're not financial services in the way they should be.
Okay, so let me come quickly to Ajay here. You know, what about the counter argument that if you're going to lease out, in a sense, the financial savings of the country to foreign investors, over the longer period, there'll be a lot of transfer of resources out of India by way of dividends and other flows to foreign capital. That's a point of view, right?
Yeah, but that's an old argument which has been employed in the FDI question all along.
Right.
That we welcome FDI in India. We would like for a foreigner to come to India. We like that Toyota is in India, making cars in India, producing good cars to compete in India, giving jobs to people in India, creating immense skills in the hands of the individuals who work inside Toyota, who are Indians, who will stay in this country, who will move to other jobs, who will diffuse Japanese quality management into other businesses in India. It's the exact same argument. All these things apply in finance.
Yes, but I guess the counter argument there is that the financial savings of a country, quite different from the ability to manufacture cars.
So can we decouple the FDI question from the capital controls question?
Right.
Okay, so level 1, just for purpose of argument, you could say, not that I agree, you could say that an insurance company in India should not invest any assets abroad.
Right.
Okay, and you could apply that equally to LIC or to foreign insurance companies.
Right.
But under that, don't you think we should have 100% owned foreign insurance companies? It's like having Toyota in India.
I do.
Exactly. So we are better off if people from abroad who have skills in how to run insurance companies will be here in India, will be offering products that are good for consumers, and will be growing a cadre of employees who know how to do this business.
Rashesh, to you. Now, you know, you've built a company yourself from scratch to a particular size. Would it have been possible if you did not have certain protections, if from day one everything was open 100% to foreigners, would Indian companies have gathered muscle and size?
I would think so. Actually, I think competition spurs, like as you know, in our case, we started in capital markets, which is very open. And,
Right.
you know, we have a lot of global competitors out there. And I think competition does spur a lot of innovation, creativity. And I do believe that Indian corporates, Indian managerial capability can stand up to global competition. So I think that is
Sure.
the first one.
Yeah.
But I think all these three things that we have, there are two parts of that. One is FDI,
Yes.
and the other is the privatization of government hold over the financial sector, whether
Correct.
it's insurance, whether it's banking. I think complete privatization is obviously will be ideal, because on the whole, in principle, I believe that anything that can operate in the private sector should not be the business of government.
Right.
Having said that, I think it may not be politically easy because of the way things have evolved. It happened, I think, in '69 that we started. Insurance companies got nationalized, banks got nationalized. If you can't do that, at least make the banks and insurance companies independent. Allow the CEO appointment, allow the ED appointment, allow them to be working as independently as possible. And also, as I would say, list LIC in the market, allow the board control to happen, and you can also do. What I'm saying is, you can do it step by step also.
Yes.
If you can't do it all the way, if you can do it all the way, that is ideal. But the other one is on FDI.
Yes.
So I think privatize and make government institutions
No
as
argument.
independent, very good.
Yes.
The other is FDI, and I think FDI also, I have the same view. I don't think Indian corporates need any protection anymore. I think a lot of Indian companies have gone abroad, and we are competing
Wonderful to hear
outside.
that. Wonderful to hear that. Let me take a quick audience poll, and then I'll come to Dheeraj to sum it all up for us. Do you believe that we should completely open up our financial sector to foreign capital? 100% FDI. How many of you are in favor? All right, so now we have an audience which is getting aggressive about it, as aggressive as our panelists.
Can I just come into this? When I used to work in the Ministry of Finance many years ago, Yashwant Sinha was championing a proposal to bring down government holding in public sector banks to 33%.
Right.
Okay, not 0%.
Yes.
33%, biggest single shareholder.
Yes.
They would have control. He found zero support amongst BJP MPs for the proposal.
Absolutely.
So I think that
the BJP has been very inconsistent on this.
I
Very
think this is a real problem. And we need all these people to march on the streets saying we want government to run the police and the judiciary and not banks.
And not banks, Dheeraj.
No, absolutely. I think it's one of the greatest myths of this country that nationalization of banks and insurance and so on helped include the excluded. Because, I mean, if you see, double the amount of people have a mobile phone connection, which is private sector driven, than those who have a bank account, which is completely public sector driven.
That's
so
right.
this myth needs to just be done away with once and for all. It does not help inclusion, that the fact that government owns banks or insurance companies. So both banking and insurance, the coverage is not good enough. We need choice. The only way to get choice is to open it up to private competition. So the FDI, I think, should be top priority, followed by privatization.
Okay, so we have almost unanimous consensus here that privatization, certainly. FDI, go right ahead. And we've put 51%. We may have been a bit conservative. Everyone says 100%, including our panel. I come to points 6 and 7. These are almost technical sounding points. So I'll request our panelists to try and keep it as simple in their explanation as possible. We are saying point 6, liberalize the corporate bond market and integrate it with currency and derivatives market. And we've pretty much said that you've got to abandon the statutory liquidity ratio and CRR, the cash reserve ratio, which simply means that the government just gets everyone's savings and they don't go into other productive channels. Point number 7 is open the derivatives market to provide for investment risk hedging. Now, this is very technical. Percy, you've got to simplify it for our audiences. Point 6 and 7.
The reality is, in the world we live in today, there is no such thing as a bond market that really operates outside a currency and a derivatives markets at the same time. The bond market around the world is about $100 trillion US. And with that kind of exposure, people need to hedge their currency risk as well as their interest rate risk.
Right.
So in this day and age, one of the things that almost nobody, either at the street level or in Parliament, understands is that it's impossible to have an efficient bond market without having efficient currency and derivatives markets.
Right.
I don't want to get too technical about the derivatives markets because it is quantitative and it is complicated. But this notion generally that it's a market for speculators is a profoundly wrong and fundamentally misconceived notion. It's actually a market that enables you to risk manage.
Right.
Now, so from my point of view, unless we have open derivatives markets, we won't have an efficient bond market. And if government keeps preempting the bond market, we won't have a bond market that's accessible to anybody other than the government.
Right.
Which is the problem we have today.
Which
Let
is the
me
big problem.
also come to one point.
Yeah. Yes, go ahead.
Let me come to one point you made previously. This point about worrying about financial savings of Indians being exported.
Yes.
It's a fundamentally misconceived notion for one reason. Countries like India, which are capital short, need to offer investors from around the world a better risk-adjusted return than anyone else offers. In fact, between 2000 and 2008, 2007, we more or less did that.
Right.
But since 2009, with the actions we've taken on retroactive taxation, with the problems that the government has gone into with corruption, etc., if you look at political risk in India, policy risk in India, project implementation risk in India, currency risk in India,
Yes.
we no longer offer a better risk-adjusted return
Right.
than other markets.
Okay.
And so we're bound to lose money.
Okay.
In a sense,
But-
running your financial market properly gives you the ability to discipline yourself to make sure that you offer a better risk-adjusted
Right.
return.
So let me come across to Ajay. Ajay, the case is made. How? I want to understand from you how. What are let's say the three things the next Prime Minister must do immediately to get it going?
The root cause of the problem is that at present the regulation of the bond market is done by the Reserve Bank of India. And the Reserve Bank of India has taken a strategy that this country does not need a bond market. So it just links back to what we were saying earlier, that you hand this over to SEBI and you're done. Because SEBI is in the business of regulating markets. It does not come with a
But why? Why has the Reserve Bank of India taken this call that we don't need a bond market? Because if you don't have a bond market, you don't have long-term finance. You don't have long-term finance, you have the problems that you're seeing in all your PPP projects today.
The Reserve Bank of India has a certain philosophy of control. They have hundreds of levers where they would like to keep everything under control. It's more of a central planning approach, like an old license permit system,
Right.
which has been dismantled in the real sector, but is still alive and well in the financial sector. And we have to confront that.
Right.
It is a skills problem, it's an attitudes problem. We need to change the laws. And the easiest path is to really hand it over to SEBI.
Hand it over to another body.
Because SEBI has the right ethos and philosophy.
And it's a young body.
Yes.
And it's done very well with the stock markets.
Exactly.
Rashesh.
I think absolutely agree. But I think in the bond market, the issues are a bit slightly more complex, because I think currently bond market will compete with the credit market, with the loan market that the banks operate in. And I think Reserve Bank is fairly worried that the bond market will bring in the volatility, because bond markets are brutal. There is a high degree of discipline. Like if you're a corporate and you don't pay interest for a day, you become you'll go into default in the bond market. While in a bank loan, you can make adjustment. You can pay 30 days, 40 days.
Or you can make lots of adjustments.
You can
as
make
we
a lot
see.
of adjustments.
Yes.
So I think but I think on the whole, for both the bond market and the derivative market, we need to introduce this in our financial system completely.
Exactly,
because
Rashesh. A $1 trillion private sector should be able to withstand brutal bond markets.
Absolutely, and I think the world has become complex. We are very integrated with the world. I think our currency markets, and increasingly we are seeing a lot of activity in our currency, in our bond, interest rates overseas also. So we are integrated with the world. We have to say complexity is here to stay. See, on the whole, we have a problem. We don't like the word markets, we don't like volatility, we don't like derivatives, we don't like innovation, we don't like complexity. But we can't hold back the economy.
We like the government.
And on the whole, in a way, Raghav is like saying, because there will be a few accidents on the road, so we need to make all cars
Stop
go
driving.
back, the way they were in the 80s.
Stop driving.
So we have to open it up, and we have to go forward and take the risk.
Right.
I mean, I think this is very fundamental to growth. Forget the complexity of it, but as the panelists have suggested, very easily can be done. Give it away to SEBI. RBI's interest, because as long as it manages government debt, will be to manipulate the bond market. As long as the government keeps borrowing and borrows cheaply, the private sector will be kept out. So I think that needs to change. We need to give a push to the private sector more than the government.
Okay, so this was a pretty technical one, and I'm sure pretty technical for the next Prime Minister as well, who may not be as well versed in finance as our panel. But the core thing is, go for it. Well, before we go into a break, we've got this very young and energetic and eager audience. They've got a lot of suggestions which they've put on placards. So I'm going to ask them to put those placards up so that all of you can see it. And if you want to contribute your suggestions, just look at the hashtag, tell the next PM. Tweet us your recommendations as well. Look at these placards. Welcome back to Change India, an agenda for the next Prime Minister. Today our focus is on financial sector reforms. We've already talked about 8 fairly technical sort of points. Point number 9 has been in contention for so long. We are saying go for it. India is ready for full convertibility of the rupee on the capital account. Remember, India is fairly convertible on the current account. So if you want to send your child abroad, you can get dollars. But if you want to go and buy a company abroad, you need approvals from the Reserve Bank of India. So we are saying open it all up. And we've got point number 10, which is really on Financial Sector Legislative Reforms Commission. Ajay, I'll come to you on full capital account convertibility. You know, we've had in this series some very pro-market thinkers who, when it came to this point, were actually feeling that perhaps a little bit more control is needed. Your thoughts?
So I want to say that the horse has bolted. Okay, India is de facto an open capital account. When the chips are down, okay, each of us can take $200,000 out. All the large corporations are multinationals. They operate a global treasury in London. FIIs have convertibility. I could go on. Yes. Look back at 2008, okay, when Lehman blew up.
Yes.
That was on late Friday evening.
Yes.
All of us knew.
September 14th.
Yes.
Yes.
Okay. All of us knew that this was a great event in the world economy, but we all slept nicely that weekend, thinking, you know what, we in India, we're so wise. We've got these capital controls. They'll keep us safe. Okay. You know what? On Monday morning, the Indian money market choked. And the choking of the Indian money market that Monday was worse than any other emerging market. So I think this idea that we have a working system of capital controls is an illusion. Once you develop a sophisticated private sector, once Tata Steel owns Chorus,
yes,
and is running a global treasury,
or
it's
Tata
game over.
Motors owns Jaguar.
Correct. So I mean, let's wake up and smell the coffee.
Yes.
India is an open economy. Now let us act our age and live in the policy framework of a country with full capital account convertibility.
Ajay has laid it out for us that, listen, in effect, we are fully capital account convertible. So whatever little that is left to be done, why don't we just go ahead and do it?
No, I agree. I think that what the government needs to explain is why, in the whole plethora of controls, etc., we have, the only individual discriminated against is the Indian resident. The non-resident Indian can move money as he likes. A very wealthy Indian can move money as he likes. The only capital controls that apply are to the middle class or poor Indian who does not have the flexibility to manage his risk outside the Indian rupee and outside of what the government offers him by way of savings. And the government escapes discipline by doing that. From my point of view,
Percey,
the other issue here, with lack of convertibility and capital account controls, is that India is depriving itself of the opportunity to earn about $10 to $15 billion a year in export earnings from the export of financial services.
Right.
We are really crippling ourselves by imposing controls on ourselves, which are totally unnecessary. And these clarion calls in the IMF and by Danny Roderick, etc., saying, look, capital controls are necessary, they should be reimposed. I think this is profoundly wrong, illusionary thinking.
But what about,
because if that was the case,
so
then the United States would be imposing capital controls.
Let me put the other side of the argument. Countries in Asia and several other emerging economies have come through periods where, due to very quick fluctuations caused by very quick inflow and outflow of capital, they've had to face problems. Even we had a situation where the rupee went from 58 to 68 in something like a week. And then that seriously dislocated a lot. So isn't there some argument? And I'm going to come to Rashesh after that.
No, there isn't, Raghav. There isn't an argument for one reason. Those distortions are caused by mismatches in policy. When the government emits one signal on the fiscal account and a completely different signal on the monetary account, and the market misreads those signals, then the market overcorrects later on when it reads those signals properly and says this doesn't make sense. You cannot blame the lack of capital controls or the presence of capital controls, because these problems have occurred even in countries with serious capital controls.
So I think you won the round there, Rashesh.
Yeah, I think the only point I would add is the exact example that you gave.
Yes.
It highlights, see, we already integrated. We already have the cost of integration. We are not getting the benefits of integration because, as you said, when global outflows happen, when there was a risk-off situation, India also suffers as part of that.
Yes.
So we are not insulated. We might think we are insulated.
Yes.
And I think on the whole, we need to get away from this obsession about rupee value. I think we always think that strong rupee is good for India and a weak rupee is bad for India. I think it just adjusts. And
It's
currency,
almost the other way around, actually.
and actually currency is the first shock absorber for the economy. We need to allow the shock absorber to do its own work.
Yes.
And if we are, because we are anyway there, we are already half pregnant out there, we might as well go all the way.
Okay. Dheeraj?
Yeah, I think it's an idea whose time has come. I think we've been flirting with it in various ways and then doing it by stealth along the way. You liberalize it for companies, you liberalize it for NRIs. And as Percey said very rightly, it's just the middle class, ordinary investor who's excluded from it. So it's time it's done, and I think it doesn't work. I mean, in the last a few months ago when the rupee was falling, the government imposed some capital control measures, but they don't work.
But that was laughable.
Yeah, but I mean, you can try it, but the markets will beat you down. And,
Yes,
and I
exactly.
mean, India is integrated enough and the markets are too strong globally.
On the other hand...
And if your fundamentals are all wrong, then you can't expect capital controls to set it
Yes.
right for you. It may delay it by a few months, but the reality is going to sink in at one time or the other.
And on the other hand...
may as well face reality as it comes.
Yeah, and when they actually allowed the market to function and opened the FCNR window is when the rupee started recovering. So if that window was always open...
In fact, that was counterproductive to impose the capital control.
Okay, so back to our audience. How many of you think that India is ready and let's get on with full capital account convertibility, really become a developed economy? See, our audience is really aggressive. I'm so happy, and I think...
Can I come back into this?
Yes.
I want to link back to the insurance question.
Yes.
Okay. Would you rather have an insurance company in India which is forced to invest only in India? Or would you like to make it safer by diversifying all over the world? Okay, it's a slam dunk.
Yeah.
We will reduce the risk of a bank in India, of an insurance company in India, and thereby improve the product offerings of everybody in this room if we clean up our minds and say, look, money should go all over the world because we reduce risk through diversification.
You know, we've got these 10 points. I think, Dheeraj, we need an 11th point. Indian planners need to get rid of, Indian politicians need to get rid of the East India Company mindset. I think we need to get rid of that. That should be point 11 in all points.
Yeah, I think we've got, as Ajay said earlier, we've got rid of it in the real sector to quite a large degree, but for some reason, agriculture remains untouched and finance is the other.
Is the other.
Very different spheres, but they sort of remain untouched by reform and still in the sort of the old mentality. But this is really about ordinary citizens. It's about all of us getting cheaper financial services. I mean, the world over, okay, we react to the Lehman crisis by saying, look, we are conservative, we are better off. But are we better off? I mean, none of us can afford insurance, none of us can afford a bank account. It's not better off. I think for the ordinary citizen, we need liberalization of this sector.
Okay, so we're now on to point 10, and this is not open to much debate. So I'll just read it out. Implement recommendations of the Financial Sector Legislative Reforms Commission. Over to you for 30 seconds to tell us why it has not been done to date.
I think largely because of the vested interests involved with regulators, with a large number of RBI people and ex-RBI people who argue against it in order to protect their vested interests and to retain an old structure of empire which is now totally dysfunctional.
Okay.
I think Ajay has had more to do with FSLRC than most people.
Okay.
And I don't think most Indians realize what a fantastic, phenomenal exercise this has been.
Yes.
Frankly, when I talk to people in the UK and the US, they're full of admiration for what has happened.
Right.
But not full of admiration for the fact that we're paralyzed in implementing it.
That's it, Mr. Prime Minister or Madam Prime Minister. This is a point that is ready-made, tailor-made, cooked on your table. All you need to do is get it going. These are the 10 points we'll give to you when you take office. And before we go, have a look at all the 10 points.